The next objective is accounting for cash dividends. So, assuming a corporation is profitable, they have many options for using their cash. They can spend the cash to grow the company. They can buy new buildings, construct new buildings, hire new employees, buy another company. They can save the cash for using it later, and they can pay dividends. Now, you'd think of paying dividends as the same as an owner and a sole proprietor drawing out money. So you can think of as an owner draw, think of dividends as an owner draw for corporations. Because remember, the draw is when the owners take money out of the company and use it for personal use. And a dividend is being paid to the stockholders, and the stockholders are the owners of a corporation, and they're spending it on whatever they want for their personal use. But remember, not all corporations pay dividends. They are optional. And even if they do pay dividends, they can increase the dividend, they can decrease the dividend, or they can even stop the dividend. So here we have the three main categories of our accounting equation: assets, liabilities, and owner's equity. So what we're going to do, we're going to look at how these accounts are affected when the owner takes money out of a company for personal use. So let's think back to a sole proprietor. How is this accounting equation affected when the sole proprietor takes money out? What basic types of accounts will eventually be affected? Well, cash, of course, an asset, is going down. And then the capital account, an equity account, that's what the Q stands for, is also going down. At the time of the draw account is technically increasing, but it's eventually close to capital. That's why I say up here what types of accounts would eventually be affected. So cash decreases and equity in the form of capital for a sole proprietor decreases. Well, now let's look at the same situation but for a corporation. So for a corporation, cash, of course, would be going down. And then eventually, the account that will be affected is retained earnings. Remember, retained earnings, my definition of retained earnings is past profits that have not yet been paid out in the form of dividends. So if we do pay a dividend, then the retained earnings has to decrease. Now, technically, when we'll find out later, when we declare a dividend, it's going to go into a cash dividends account, but that will be closed to the retained earnings account. So cash dividends is similar to the drawing account. So now let's look at the dates of a dividend. Dividends have 3 dates. They have the declaration date, the date of record, and the payment date. So let's talk about the declaration date first. That's when the board officially declares we are going to pay a dividend. But the thing is, the company does not pay the dividend on the day they declare it. As you can see down here in our example calendar, they might declare it on the 1st of May. 2 weeks later, they have what's called a date of record, which we'll explain in just a minute. And then at the end of the month, 2 weeks after that, approximately, they pay the dividend. So because the company on the declaration date is promising to pay a dividend, this creates a liability. And then on this date, they will also say the date of record. They will announce the date of record and the payment date. So what's this date of record? Well, anyone who owns the stock on this date of record, in this case down here, May 15th, whoever owns it on May 15th will get the dividend when it's eventually paid about 2 weeks later. And then the payment date, of course, that's when the company writes the dividend checks. And the dividend checks aren't really written anymore. They're direct deposited into your stock stockholders and into the stockholders brokerage account. So let's look at an actual dividend announcement. So Safeway Incorporated. By the way, the NYSE means New York Stock Exchange. The SWI is the ticker symbol of Safeway. So if you're looking for the stock quote for Safeway, you just type in SWI and it goes to Safeway. You don't have to spell out Safeway, etc. So on December 8th, Safeway announced that its board of directors met and they declared a regular quarterly cash dividend of 12 cents a share. The cash dividend will be payable on January 13th to stockholders of record at the close of business on December 23rd. So pause the video for a second and answer this question. What's the date of declaration? It's the date they announced this dividend, so it's December 8th. What's the date of record? Now remember, the date of record is just simply the date that someone has to own the stock for them to eventually receive the dividend. So according to this paragraph up here, you have to own the stock on December 23rd. So that's the date of record. And then lastly, what's the payment date? Well, obviously that's January 13th. So let's see how cash dividends are expressed. So for common stock dividends, it's pretty simple. The dividends are expressed as a flat amount per share. For example, it might be 20 cents a share. Let's go back to the previous example. This is for the common stock. It doesn't say that it's for the common stock, but it is. Notice it just tells you the dividend is simply $12 or 12 cents per share. Now, for preferred stock, it gets a little bit more complicated. Dividends are expressed in one of two ways. It can be expressed as a percent of par. For example, it's not going to say 20 cents per share. It might say 5%, $100 par. What that means is that the stock has a $5 dividend. How do I calculate the $5? It's the $100 par times 5%. So it could be stated as 5%, $100 par. So that's the dividend for preferred stock. But they could also just give it a flat amount per share. For example, it could say $5 per share, or it could say $5, $100 par. Now, so this $5 means it's a $5 dividend.